Welcome back to Smart Stock Sam. Imagine a company just posted its best year ever, shattered multiple performance records, and within hours, the stock absolutely crashed 8%. Sounds like a complete disaster, right? Wrong. What if I told you this might be the most explosive buying opportunity we've seen in months? Today, we're diving deep into Robinhood's post-earnings chaos to answer the ultimate question. Is this fintech giant sitting on a massive discount with genuine 100% upside potential, or is Wall Street finally seeing through the hype? Let's find out. Let's cut through the noise and look at what actually happened versus what the market thinks happened. The headlines screamed panic. Robinhood dropped 6 to 8% after missing revenue targets. Investors hit the exit button. Algorithms went into sell mode. But here's what they missed. The company's valuation just got recalibrated from an unsustainable 70 times earnings down to a much healthier 37 times. Even with all the Q4 turbulence, Robinhood pulled in a record-breaking $4.5 billion in annual revenue. And get this, their Rule of 40 score hit 108%. For those who don't know, anything above 40 is considered excellent in fintech. Robinhood just tripled that benchmark. So if the year was this successful, why did one quarter send everyone running? Here's where it gets interesting. When you actually break down the numbers, they beat earnings per share expectations, coming in at 66 cents. That's the profit metric, and they crushed it, but they missed on total revenue, EBITDA, and average revenue per user. This is what triggered the algorithmic sell-off. The machine saw a revenue miss and reacted instantly. But here's the critical question nobody's asking. Was this miss because customers are leaving, or is something else going on? The answer might surprise you. Management openly admitted they're investing in what they call the war for liquidity. They rolled out a tiered rebate model specifically designed to attract high-volume institutional traders. Think about it like this. They're sacrificing a few pennies per trade today to capture massive dollar flows tomorrow. Layer on top of that the ongoing crypto winter, where trading volumes naturally compress, and you get that $1.28 billion quarterly result. But notice what's not happening here. User churn is virtually non-existent. People aren't abandoning the platform. The revenue structure is just evolving. Which brings us to the single biggest shift in the Robinhood investment thesis that nobody's talking about. For years, if you owned Robinhood stock, you were basically making a leveraged bet on Bitcoin. When crypto went up, Robinhood soared. When crypto crashed, Robinhood got destroyed. That correlation just died. Crypto revenue now represents less than 20% of their total mix, down from being the dominant driver just 2 years ago. They've successfully built out 11 separate business lines that each generate over $100 million annually. And while retail crypto volume was down, their institutional crypto platform Bitstamp saw volume surge 20% quarter over quarter. They're not abandoning crypto, they're professionalizing it. But while everyone was obsessing over crypto volatility, Robinhood quietly achieved something that should terrify every legacy broker on Wall Street. Robinhood just captured the #1 market share position in the options trading industry. Let that sink in. They went from 0 to #1 in one of the most profitable segments of the entire financial market. Using those same tiered rebates we discussed, they outmaneuvered giants like Charles Schwab and TD Ameritrade. They proved they can win the liquidity war, which creates a massive competitive moat against temporary headwinds in other segments. But here's the real secret weapon that transforms Robinhood from a trading app into something much bigger. The Gold subscription engine is quietly building an ecosystem that locks users in for life. Gold subscribers exploded 58% year over year to 4.2 million members. These aren't just casual users. These are people paying monthly fees for premium features, and in return, they're funneling their entire financial lives into the platform. Annual net deposits hit $68 billion. The new Gold card is turning Robinhood into your primary bank, your investment platform, and your credit provider all in one place. This is the super app thesis coming to life. And if you think that growth rate is impressive, wait until you see the velocity in their newest market vertical. Prediction markets just entered what analysts are calling a super cycle, and Robinhood positioned itself perfectly. Under their old revenue model, they earned roughly 1 cent per contract traded. With the new Rothera joint venture, where they actually own part of the exchange infrastructure, they're now earning 2 cents per contract. That's a 45% economic boost on a segment that just recorded its highest January volume in history. Other revenue, which includes prediction markets, already jumped 300%. But here's the critical question. Can they scale this growth without costs spiraling out of control? Because that's where most high-growth fintech companies fall apart. Robinhood has a hidden weapon. They're pivoting to what they call an AI-first operating model, and the numbers are staggering. Their target is 50% plus revenue growth, while limiting expense growth to just 18%. That margin expansion is being powered by their proprietary AI system called Cortex. Think of it as an AI assistant built specifically for traders and operations. It's already delivering 9-figure annual savings in engineering costs. Get this, 75% of all customer support cases are now resolved by AI without any human intervention. This efficiency advantage is how they plan to dismantle the old guard. When you stack Robinhood against legacy incumbents like Charles Schwab or Morgan Stanley, the competitive advantage becomes crystal clear. The old guard is buried under high fee structures and decades of accumulated technology debt. Robinhood is AI native from the ground up. They're agile, they're lean, and they're positioned to capture the massive wealth transfer that's happening right now as millennials. And Gen Z inherit trillions of dollars between 2026 and 2030. So after all the Q4 chaos and the post-earnings sell-off, what does the immediate future actually look like? 2026 kicked off with absolute record momentum. January equity trading volumes surged 57% compared to Q4 averages. Net deposits exceeded $7 billion in a single month. February is tracking even higher. All that Q4 noise everyone panicked about, it's already being drowned out by explosive real-time usage data. The business is accelerating, not decelerating. So after everything we've covered, what is this stock actually worth? With the crypto discount now fully baked into the current 37 times PE ratio, the asymmetric upside is massive. Wolfe Research just issued an outperform rating with a $125 price target. Based on their elite Rule of 40 performance, some valuation models suggest fair value could be as high as $151. We're looking at a top-tier fintech company trading at what could be a significant discount to intrinsic value. But before we get too excited, we need to talk about the downside risk. From a technical perspective, the stock has established a solid support floor between $78 and $79. The primary risk remains a prolonged crypto winter that extends volatility and compresses trading volumes across the entire platform further than current projections. But even accounting for that risk, the asymmetric reward here is capturing the automated future of capital markets. You're potentially risking a limited 10 to 15% downside for a possible 50% plus move to the upside. That's the definition of asymmetric opportunity. So what's the final verdict? Before my final verdict, here's the important disclaimer you need to hear. This analysis is based on publicly available press releases, market research, and SEC filings. Everything shared in this video is for educational and informational purposes only and should not be construed as investment advice. I am not a licensed financial advisor. You should always conduct your own due diligence and consult with a qualified financial professional before making any investment decisions. Past performance does not guarantee future results, and all investments carry risk, including the potential loss of principal. So the final verdict is buy the dip. Robinhood has transformed from a meme stock into a real business with real economics. The strategic decoupling from crypto volatility is working exactly as planned. The valuation reset after earnings provides a legitimate margin of safety that didn't exist 3 months ago. And their AI leadership with Cortex will drive the next major leg of growth. The super app isn't some future vision. It's already here, generating billions in revenue, and it's trading at a discount. That's the complete breakdown on Robinhood and why this post-earnings dip could represent exceptional value. If you found this analysis valuable, smash that like button, subscribe to Smart Stock Sam for more deep dives into market-moving opportunities, and drop a comment below with your thoughts on whether Robinhood is genuinely undervalued or if the market is pricing in risks we haven't fully discussed. I'll see you in the next one.